Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. Well, my partner Ed Seafried talked about GDP last week. And what started to go through my mind as I was listening to Ed's webcast was, well, look at those Fed projections in terms of GDP for the year. Certainly they brought it down from their previous projections, but still looking at these projections being at 2.1% on the low side to 2.3% on the higher side. And of course, we had that new GDP final estimate at negative 2.9%, which of course Ed talked about was quite a surprise that no one was expecting that much of a decrease. So what do we have to do? Because we've talked about before that the Fed has, over these past years, as they become more transparent, have also been more exuberant about the economy than what others have, including myself. So when we look at this, what do we have to do for the year? Well, it means for the next period of time, meaning each of these quarters, second quarter, third quarter, fourth quarter, that we're going to have an average GDP of 3.78%. On the other hand, if we look at the overall 2.3%, that would indicate a growth rate of 4.04% for the rest of the year. And we have to sit there and think, is that attainable? Or is the Fed once again looking at this economy with rose-tinted glasses? Well, we can go and we can look at the Bloomberg economic consensus over these next number of quarters. And what they're showing is 3.5%, moving up through the end of the year to 3.1%, actually down a little bit to 3.1%. This gives us, with a 2.9, an average of 1.68% for the year. Very different from the Fed being at 2.1 to 2.3%. So when we look at that on an overall basis, expectation is, let's look at the Fed slides from Fed Philadelphia that we monitor on a monthly basis. The 3-month change, looking back over the last 3 months, you'll see that it's 0.6% in March, 0.8% in April, 0.8% in May. Once again, not at a very fast growth rate, a growth rate similar to last year. Then let's look out 6 months, and the leading index in here, 1.6% in March, 1.8% in April, 1.7% in May, indicating a similar type of growth that what the Bloomberg consensus is saying. So when we think about that, is that most likely the Fed is over-exuberant in terms of their expectations on this economy. Once again, when we look at it from the standpoint of raising short-term interest rates, that does not seem to be in the cards with this kind of anemic economy. But one thing we'll point out is, if you remember when we looked at these in the previous month, that we were seeing over 11 states that were showing negative growth. And that has reduced itself down to 6 states in here showing negative growth, which at least is a positive sign, not suggesting that the economy is going to be moving into any kind of recession, but once again, anemic, slow type growth. Then we got the number in terms of unemployment. And if you remember, unemployment, 6.1%. But as we've talked about, the Fed said they're going to be looking at these shadow type employment situations. For instance, we look at part-time for economic reasons. And that essentially remained in the same area that it has over the past number of months. So we saw no improvement there. Second, looking at long-term unemployed 27-plus weeks, once again, this is a positive sign continuing to move downward. But the thing that we point out is, even at the level that it's at, going all the way back to 1955, is still at very elevated levels. Labor force participation rate, once again, remaining doggedly right around the same level that it has been for the past number of months, not having any kind of significant downward move. But once again, when we look at it over time, that the participation rate is nothing like we've seen in the past, and going all the way back into the 70s. So when we finally look at compensation in terms of the employment cost index and 12-month change, this remains doggedly low, saying that there really is no increase in employment costs. In fact, the most recent number, a slight downtick. So that would still suggest that there's concern from the Fed in terms of the overall employment situation, not just looking at it as unemployment. Once again, underlying that growth, employment, and then, of course, the inflation type numbers suggesting that short-term rates remain low into 2015 and maybe even beyond. This is Jay Brew. Have a great week.